Fiscal focus. The real reason the US dollar is losing value. The US dollar has long been regarded as the world's most powerful and stable currency, serving as the global reserve currency and a symbol of economic dominance. However, in recent years, concerns over its declining value have intensified. Inflation, excessive government spending, rising debt, and shifts in global trade dynamics are all contributing to the weakening of the dollar. While some may attribute the decline to short-term market fluctuations, the truth is far more complex. This video explores the real reasons behind the dollar's depreciation and what it means for the future of the US economy. The role of inflation. One of the most immediate and visible factors affecting the dollar's value is inflation. When inflation rises, the purchasing power of a currency decreases, meaning that consumers need more dollars to buy the same goods and services. Over the past few years, inflation in the US has surged due to a combination of supply chain disruptions, increased demand, and expansive fiscal policies. The Federal Reserve, which plays a critical role in managing inflation through interest rates and monetary policy, has struggled to keep inflation under control. While raising interest rates can help slow inflation, it also increases the cost of borrowing, which can stifle economic growth. The challenge for the Fed is to strike a balance between controlling inflation and maintaining economic stability. However, the persistent rise in prices has led many to lose confidence in the dollar's ability to retain its value over time. Government spending and national debt. Another significant factor behind the dollar's decline is the U.S. government's excessive spending and mounting national debt. The U.S. government has been running large budget deficits for decades, but recent stimulus measures and increased federal spending have pushed debt levels to historic highs. As of 2024, the U.S. national debt has surpassed $34 trillion, raising concerns about the government's ability to manage its financial obligations. When a country accumulates high levels of debt, investors may begin to question its ability to repay, leading to a decline in demand for its currency. Furthermore, to finance this debt, the Federal Reserve often prints more money, which further devalues the dollar. Foreign investors, who once viewed U.S. Treasury bonds as a safe haven, are now exploring alternative options, leading to reduced demand for the dollar. As trust in the dollar diminishes, its value continues to erode. Global de-dollarization efforts. The dominance of the U.S. dollar in global trade is being challenged by a growing movement toward de-dollarization. Many countries, including China, Russia, and even some U.S. allies, are actively working to reduce their dependence on the dollar. China, for example, has been promoting the use of the yuan in international trade and has established agreements with several countries to conduct transactions in local currencies instead of the dollar. Similarly, the BRICS nations, Brazil, Russia, India, China, and South Africa, have explored the idea of creating a new currency to compete with the dollar in global markets. As more countries seek alternatives to the dollar, its global influence weakens, reducing demand and contributing to its decline in value. If the trend continues, the U.S. may lose one of its most significant economic advantages, the ability to issue debt and conduct trade in its own currency without facing major exchange rate risks. Trade deficits and the weakening dollar. The United States has long operated under a trade deficit, meaning it imports more goods and services than it exports. While trade deficits are not inherently bad, persistent imbalances can weaken the dollar over time. When the U.S. imports more than it exports, it results in a higher demand for foreign currencies and a lower demand for the dollar. Countries that export to the U.S. accumulate large reserves of dollars, which they may choose to invest elsewhere rather than holding onto a depreciating currency. Additionally, as the global economy shifts, manufacturing and production have increasingly moved away from the U.S. to other countries, particularly China and Southeast Asian nations. This shift means that more dollars are flowing out of the U.S. economy than coming in, further exacerbating the dollar's decline. The Federal Reserve's policies. The Federal Reserve plays a crucial role in determining the value of the U.S. dollar through its monetary policies. Over the years, the Fed has used various tools to stimulate economic growth, including quantitative easing, QE, which involves purchasing government bonds to inject money into the economy. While QE was instrumental in helping the U.S. recover from financial crisis, it also contributed to an oversupply of dollars, leading to inflationary pressures. As more money is printed and introduced into circulation, each dollar loses value, further contributing to depreciation. Moreover, as the Fed attempts to tighten monetary policy by raising interest rates, the effects are mixed. While higher interest rates can make the dollar more attractive to foreign investors, they also increase borrowing costs, potentially slowing down economic growth. The Fed's actions, though necessary, often create uncertainty in financial markets, influencing the dollar's value. The future of the U.S. dollar. Despite its current challenges, the U.S. dollar remains the world's most widely used currency. However, if the trends mentioned above continue, the dollar's dominance could be significantly reduced in the coming decades. To restore confidence in the dollar, policymakers must address the root causes of its decline. This includes reducing government spending, implementing responsible fiscal policies, and working to maintain global trust in the U.S. financial system. Additionally, the Federal Reserve must carefully balance inflation control with economic growth to prevent further depreciation. While a weaker dollar can have some benefits, such as making U.S. exports more competitive, the long-term consequences of continued devaluation could be severe. If the dollar loses its status as the world's reserve currency, the U.S. may face higher borrowing costs, reduced global influence, and economic instability. The U.S. dollar is losing value for a variety of reasons, including inflation, rising national debt, de-dollarization efforts, trade deficits, and monetary policy decisions. While short-term fluctuations are expected in any economy, the long-term trends indicate that the dollar's status as the world's leading currency is under threat. If the U.S. wants to maintain its financial strength and global dominance, it must take decisive action to address these economic challenges. By implementing responsible fiscal policies and restoring confidence in the dollar, the U.S. can work towards stabilizing its currency and securing its position in the global financial system. For now, investors, businesses, and everyday Americans should keep a close eye on the dollar's performance, as its value will play a crucial role in shaping the future of the U.S. economy. Let me know in the comment section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.